We're not going to go bankrupt. I mean, at the most basic level, I'm not saying every outcome is good, but bankruptcy is not on the table. For the simple reason that our debt is denominated in a currency that we print. So in distress, people say, well, gee, what if China doesn't buy treasury notes? What if, Russia, well, they don't buy them anyway. We froze theirs. We're in the process of stealing them. But what if the world wakes up and decides they don't want any more treasury bills? You just call Jamie Dimon and say, Jamie, shoot him in. But we control you. We regulate you. We can help or destroy your destiny. So start buying more treasury securities. And they will. And I'm picking on JP Morgan, but JP Morgan, Citi, Goldman, Morgan Stanley, Wells Fargo, Bank of America, all the too big to fail banks, they would have to buy more treasury. And the Fed could always buy more treasuries. And if JP Morgan needs money to buy the treasuries, they got I don't know how many $100 billion are in reserves at the Fed. So there's plenty of money to go around, and plenty of institutions to buy. So we're never going to have a situation where nobody buys treasury securities, because if that situation even emerged, as I say, the banks and the Fed would pick up the slack. It's not likely to happen anyway. I mean, that's what I described as the default position, but the world wants treasuries. That's the thing that nobody understands, I shouldn't say nobody, but a lot of the bankruptcy critics don't understand. The biggest problem in the world today financially is not that people don't want treasury securities. It's the opposite. There's a dollar shortage. There's a global dollar shortage. And people go, wait a second, the Fed printed $10 trillion. How could there be a dollar shortage? That money didn't go anywhere. The Fed prints it by buying securities from the big banks, Goldman, Citi, the ones I mentioned. And the way they do it, they just, the open market desk calls up Goldman Sachs trading desk and says, offer me 10-year notes or 5-year notes, whatever. And Goldman makes a price, done. And Goldman sends the notes to the Fed, and then the Fed pays for it with money that comes out of thin air. That's true. And that is money printing, if you want to call it that. But what does Goldman do with the money? They give it back to the Fed in the form of excess reserves. So all you're doing is inflating both sides of the Fed balance sheet. But that money, it's not going to business. It's not creating jobs. It's not being lent to entrepreneurs. It's not helping consumption. It's not doing anything. It's just sterilized on the Fed's balance sheet. The money that does drive the economy is created by banks, not the Fed, but commercial banks. If they make you a loan or make me a loan or whatever, we can, put it to good use. That's the problem, that there's not enough of that kind of M1, M2 style money creation. But people look at the Treasury publishes, I think it's monthly or quarterly, I think it's monthly, a report of foreign holdings of U.S. Treasury securities. And people see China going down. The Chinese ownership of Treasury securities is going down, and it has been. You go, see, the Chinese are dumping Treasury securities. No, they're not. They wish they had more. They are selling them because they need cash to prop up their banks. And that's the dollar shortage. And that's going on around the world. That's extremely dangerous because it threatens liquidity. If you weaken the dollar, then Americans have to pay more for foreign goods. So if you're buying a Swiss watch, French wine, Japanese manufactured goods, vacation, whatever, in a world of weaker dollars, you're going to have to spend more to get those foreign goods and services. That may actually help the trade deficit, because if Americans say, well, I can't afford a European vacation this year because the dollar's cheap, I'll go to, the Grand Canyon or Disney World or something like that. That at the margin, that could help with the trade deficit, which the Trump administration is very focused on. But what it really is, it also makes U.S. goods less expensive from the foreign point of view. Just as it makes foreign goods more expensive for U.S. consumers, it makes U.S. goods less expensive for foreign buyers. So if you have Europeans or Chinese or Japanese or anybody else, and you need U.S. inputs, I mean, think about a world where we're manufacturing more in the U.S. and foreign trade partners want to buy our stuff, which is what we hope for, and you weaken the dollar, they can afford more stuff. It makes U.S. goods more affordable. And it's also a warning shot to the trading partners. Don't you dare cheapen your currency to offset the tariffs. We're going to cheapen our currency because we want to sell more exports. The trade deficit, of course, has two sides, imports and exports. Well, the tariffs are a way to reduce imports, but the cheapening the currency is a way to increase exports. And the combination will reduce the trade deficit and help GDP. I mean, this is all, it's a very complex, certainly complicated machine with a lot of moving parts. But this would be, cheapening the US dollar would be one of those parts. These supply chains are real. They did break down in beginning of 2018 through 2020. Of course, COVID made it worse. It did contribute to the extreme inflation we saw in 2022. June 2022, inflation was 9.1% annualized. So it has all those impacts. But Moran wants to cheapen the dollar to promote exports, which it does. You know, if you're Indonesia and you're shopping for an aircraft and your choices are Airbus or Boeing and the dollar is weaker, you might buy Boeing. And so obviously that helps our manufacturing jobs in the US and trade, reduces the trade deficit, increases exports, all the things we've been talking about. But what Moran's also talking about is threatening our trading partners. In other words, don't you dare try to cheapen your currency. And but he will not have the cooperation that James Baker had. What he wants to do is use coercion, and including the traffic light system I described. So that's the point of it. I think tariffs I'm all for tariffs against the American way, the American system. I think that's a very good move. Scott Bessen's 3-3-3 plan makes perfect sense. It's, like I said, it's simple math, but yeah, you don't have to wipe out the debt. All you have to do is reduce that ratio, debt to GDP ratio, get moving in the right direction. That will be extremely beneficial. And then, the oil production will, basically be if not deflationary, at least disinflationary. It'll fight the inflation we've all been living through. So Bessen's 3 Arrows plan makes perfect sense. Navarro's tariff plan makes perfect sense in my view. Create high-paying jobs. Those are good things. Moran's Mar-a-Lago Accord, I think it has some major problems. The first one being, it's not relying on cooperation, it's relying on coercion, which could have boomerang effects. And I think he completely misses the importance of treasury bills to the banking, to the Eurodollar system and the derivatives markets. So that's the one that I would be most concerned about. And I don't think, and I talk to some Trump people from time to time, I don't think that analysis that we've just gone through has really sunk in at the White House. Hopefully it will. The drivers, there are several, which is a good thing if you want gold to go up. I like it. Okay, so the first one is central bank buying. By the way, there's almost no retail interest in the United States. There is in other places, India, China, not in the U.S. So I run into people all the time and they say, yeah, Jim, I talked to you a year ago and then you said buy gold. And I said, yeah, did you? And they go, no, because the retail, there is no retail frenzy at all. And there's barely any retail notice. A few people are buying the GLD ETFs in a little bit, but the buying is coming from institutions, in particular central banks. So we know who they are: China, Russia, India. Actually, Vietnam is a big buyer, Mexico, Kazakhstan, Philippines. You look around, and all this data is available. You just go to the World Gold Council website. You have to give me your email address, but it is free, and they have a really good database, so you can find it very easily. And they also break it down. Turkey's another one. Iran's non-transparent, but they're buyers. So they're all buying gold as a hedge against inflation, hedge against dollar devaluation, and some of the problems we've been talking about. But the biggest hedge is that the U.S., at the beginning of the war in Ukraine, froze approximately $300 billion of Russian-owned Treasury securities. Now, Russia made the money legitimately selling oil. They got paid in dollars. They took the money. They trusted us. They bought Treasury securities, all different maturities, probably a lot of bills, but also, intermediate-term Treasury notes. And they had over 50% of their reserves in U.S. Treasury securities. But they were, because they're U.S. dollar denominated, they were held mostly in a custodian in Europe called Euroclear. It's in Brussels. So Euroclear has $40 trillion of assets under custody. It's one of the largest custodians in the world. So we and the Europeans froze those assets, which is easy to do, because the Treasury and the Fed control the ledger. They're all digital. The last paper Treasury security was issued, I think, in 1978 or 79. So maybe someone's got one in their grandmother's attic, but they've been digital for decades. So they were frozen, but we're good at that. We freeze it all the time. The idea that the U.S. doesn't do it, we do it all the time. But what was different is we went a step further with Russia. We didn't just freeze them. We started to seize them, steal them, convert them to our use and NATO. And they were collateral for a $50 billion loan to Ukraine. So think of the irony. Russia makes money selling oil. They put the money in treasuries. We steal the treasuries, use it to borrow money, and give it to Ukraine to fight the war against Russia. So that's what's going on. Well, India, China, Saudi Arabia, even Japan, Taiwan, others. And some of these people have upwards of $1 trillion, not quite $1 trillion, but upwards of $1 trillion treasury securities. Taiwan certainly does. They're looking at this and saying, wait a second, what if the U.S. wakes up and decides they don't like what I'm doing, or they don't like my policy? Are they going to do this to me? Well, how do you know? Well, one way to protect against that is physical gold. It's not digital. You can't freeze it. You can't seize it. Assuming you repatriate to your own country, put it in a nice vault, have an army, no one's going to touch it. By the way, Russia did that. In addition to, I mentioned $300 billion in treasury securities, but they had $150 billion at the time of gold, physical gold. And I would say Elvira Nabiullina, she's the head of the Central Bank of Russia. I would say she's the only central banker in the world who actually understands her job. But they put so much of their reserves in gold that has preserved them and helped them get through the seizure of the U.S. Treasury securities and actually keep the Russian economy going and keep fighting the war in Ukraine.